When you listen to the people who actually move money for a living, fund managers, credit analysts, CFOs, the people who sit in conference rooms staring at balance sheets instead of headlines, you start to notice the same tone creeping into their conversations. It's not panic. It's not excitement. It's something quieter. A kind of pressure in the background, like the early shift in the wind before a storm you can't see yet. Nobody's calling it a collapse. Nobody's screaming crisis. But the way they talk, the way they choose their words, you can tell they're watching something they don't entirely trust, and that something is the credit market. Stocks are noisy. Crypto is emotional. But credit? Credit is the part of the financial world that shows you what people actually believe, not what they hope. Credit doesn't care about hype or headlines or optimism. It cares about risk. It cares about cash flow. It cares about whether you can pay your bills when the music stops. And right now, credit is telling a very different story from the one the broader market is selling. What's unusual about late 2025 is that nothing looks obviously broken. There's no Lehman moment. No housing bubble on the brink. The economy isn't falling apart. Job numbers aren't setting off alarms. And yet, the people who understand the plumbing of the system are acting like the floor under their feet isn't as solid as it used to be. Companies that could refinance instantly a few years ago now take longer. Deals that should close in days get stuck in negotiation. Lenders ask for a little more protection, a little more yield, a little more time to think. It's subtle, but it's real. That's how a credit cycle turns quietly. Then suddenly, and the root of it is simple, money isn't cheap anymore. Not because interest rates are skyrocketing, but because the appetite for risk is changing. Lenders aren't as generous. Investors aren't as forgiving. The environment that allowed companies to borrow aggressively, spend aggressively, and grow aggressively is shifting into one where discipline matters again. This shift is hitting the companies that scaled too fast during the AI boom harder than anyone wants to admit. People talk about AI like it's magic, like it's destiny, like it's the next electricity. But nobody talks about the financing required to feed that entire ecosystem, the billions poured into data centers, GPU orders booked years in advance, massive engineering hires, hardware procurement, energy infrastructure. The constant push to stay ahead of competitors, a lot of that wasn't funded by profits. It was funded by debt, because the expectation was that growth would keep rising, valuations would keep expanding, and revenue would catch up eventually. That kind of thinking works when money is cheap and lenders are friendly. But when conditions tighten even slightly, that entire structure gets tested. Investors start asking uncomfortable questions. Cash burn stops being charming. And leverage stops being invisible. That's the first pressure point in today's credit environment. Too much borrowing attached to growth stories that still need time to mature. The second pressure point is the one nobody can escape. Governments are absorbing a massive share of global lending capacity. It's not just one country, it's almost all of them. Years of stimulus, geopolitical tension, military spending, infrastructure races, demographic issues. Governments are borrowing aggressively because they have no choice. But here's the part average viewers miss. Government borrowing competes directly with corporate borrowing. When sovereign yields rise, corporate yields must rise too. It doesn't matter if the company is healthy. The baseline cost of capital has changed. This forces lenders to price everything differently. Suddenly, what looked like a cheap refinancing in 2023 looks expensive in 2025. Borrowers feel that squeeze first. Investors feel it next. The economy feels it last. Meanwhile, banks are behaving like institutions that want to avoid being caught off guard. They're not shutting down lending, but they're choosing their risks much more carefully. Deal flow is slower. Underwriting is stricter. The enthusiasm for leveraged loans, once one of the hottest credit products, has cooled noticeably. Banks aren't broadcasting this as a problem, but you can see it in their behavior if you know what to look for. And underneath everything is the consumer. Households don't show stress dramatically. They show it gradually. Credit card delinquencies go up a little. Auto loan defaults rise more than expected. Buy now pay later stops looking like harmless convenience and starts looking like unregulated leverage. People feel a bit squeezed, but they don't say anything. They adjust. They cut back. They delay purchases. This isn't collapse. It's erosion. And erosion is what weakens the system before anything visible breaks. Investors aren't talking about the 2025 credit situation because something major has happened. They're talking about it because too many small things are happening at the same time, and they all point in the same direction. Tightening conditions, slower lending, higher borrowing costs, more selective underwriting, heavier sovereign funding, revenue that isn't keeping pace with leverage, consumers that are stretched thinner than the data suggests. That combination doesn't create an immediate crisis. It creates fragility. And fragility is a dangerous state for a system that relies on confidence and liquidity. The most interesting part is that there's no panic. Professionals aren't dumping assets or shouting warnings. They're simply recalibrating, reassessing, thinking in ways they haven't had to think for years. They're questioning assumptions that used to be taken for granted, like the idea that refinancing is always available, or that growth can outpace debt indefinitely, or that liquidity will always appear when needed. This kind of quiet introspection from people who see the system from the inside is usually the earliest sign that something important is shifting. Because credit cycles don't turn because of headlines. They turn because lenders stop being comfortable. Right now, lenders are not comfortable. They're not terrified either. They're just aware. And in finance, awareness spreads faster than fear. It changes behavior slowly, and that slow behavior change builds up until the entire ecosystem feels it. This is what people are referring to when they talk about the 2025 credit crisis, not a collapse. Not a replay of 2008, but an environment in which the foundations that support risk-taking are tightening, inch by inch before the public even notices. Professionals are watching the system the way a pilot watches the gauges on a plane. Not because the aircraft is falling, but because one of the indicators is moving in a direction it shouldn't. Right now, several indicators are drifting, and everyone who understands credit knows that when indicators drift long enough, pressure eventually shows up somewhere, maybe in corporate defaults, maybe in high-yield spreads, maybe in private credit portfolios, maybe in companies built on aggressive leverage that depended on constant refinancing. Nobody knows where the weak link is, but everyone can feel that one exists. And that's why the conversation is happening. Not because the crisis is visible, but because the environment around it is forming all the conditions that usually appear months before stress becomes obvious. The question now isn't whether the system is breaking. It's which part absorbs the pressure first. Credit cycles don't move evenly. They move through weak links. And 2025 has several areas where the stress could surface before it spreads everywhere else. One of the first places investors are tracking closely is the refinancing window for mid-sized companies. Not the giants, not the household names, but the firms that sit in the uncomfortable middle, too large to be nimble, too small to dictate terms. Many of these companies borrowed in the years when capital was cheap and lenders were eager. They took loans with the assumption that refinancing would always be available, and that the cost of debt wouldn't rise dramatically. That assumption worked for a decade. It doesn't work anymore. The company is approaching maturity walls in 2025, and 2026 are discovering that refinancing the same amount of debt now comes with materially higher costs. Some can absorb it through cash flow. Others can't. And when a company can't refinance on workable terms, the consequences are not dramatic at first. They start with delays, then amendments, then covenant negotiations, then asset sales. And eventually you see what credit analysts call a structured failure. Not a blow-up, a slow decline that ends in restructuring. Investors know this pattern well. They've seen it in retail, in telecom, in energy, in commercial real estate. And once it starts in one part of the market, it spreads to adjacent sectors, especially where leverage is heavy and margins are thin. Another area people are watching is private credit. For years, private credit was the quiet winner of the low-rate environment. Banks retreated from certain types of loans and private credit funds stepped in, writing deals with higher yields, customized terms, and faster turnaround. It worked until the broader cost of money rose. Private credit portfolios look fine on paper, but internally, the pressure is building, higher funding costs, slower exits, companies struggling to meet aggressive repayment schedules, and valuations that haven't been truly tested in a tighter liquidity environment. The risk isn't that private credit collapses. The risk is that the incentives inside the system shift. When a lender becomes more focused on protecting existing loans than writing new ones, the flow of credit begins to slow. That slowdown is what eventually shows up in growth numbers, hiring, capital expenditures, and corporate sentiment. And then there's real estate, not in the sense of a 2008-style collapse, but in the sense of refinancing cycles that don't line up with market conditions. A lot of commercial real estate debt comes due in the next few years, and valuations are not where owners expected them to be. Interest expense is higher, tenant demand is different, and the long-term assumptions behind some properties don't match the post-pandemic reality. This mismatch doesn't create headlines instantly. It creates balance sheet pressure that lenders eventually feel. And when lenders feel pressure, they tighten across the board, not just in real estate, but everywhere. That's how contagion works in credit. Not through panic, but through caution. You can see similar signals in the sovereign market. Historically, when governments borrow heavily, investors pay attention but don't overreact. But when multiple major economies are borrowing aggressively at the same time, the US, the UK, Japan, parts of Europe, the effect on the global yield curve becomes unavoidable. Higher sovereign yields ripple through the entire credit ecosystem, raising the baseline cost of capital for everyone else. Corporations feel it. Consumers feel it. Emerging markets feel it. And the longer this lasts, the more it reshapes expectations about what normal borrowing costs even look like. What investors worry about isn't a default. They worry about a world where the cost of refinancing stays high for long enough that leveraged companies run out of room to maneuver. Credit cycles are less about sudden shocks and more about time. Time is what kills companies with weak cash flow. Not one bad quarter, but there's another layer to the 2025 conversation that isn't being discussed openly: liquidity psychology. For years, markets have behaved as if liquidity will always appear when needed, from central banks, from emergency measures, from institutional buyers looking for yield. That assumption hasn't been tested in an environment where central banks are trying to shrink their balance sheets and where governments are absorbing a huge portion of available capital. If liquidity doesn't evaporate but simply becomes more selective, the entire risk structure of the market changes. What was once safe might simply become expensive, and what was once expensive might become unfundable. Not because the business changed, but because the financial conditions around it did. And investors sense this shift. You can hear it in how they talk about duration risk, how cautious they are about high-yield exposure, how differently they evaluate leveraged companies now compared to a few years ago. They're not pricing in collapse. They're pricing in a world where money is no longer a free commodity. This shift in mindset is what marks a turning point in a credit cycle. It's not the event that matters. It's the change in behavior. The moment lenders start asking harder questions, borrowers feel it immediately. The moment borrowers start hesitating, growth slows. When growth slows, cash flow tightens. And when cash flow tightens, the weakest borrowers show up first. Not in spectacular failures, in missed targets, revised guidance, extended maturities, strategic reviews, and updated financing plans. By the time the public realizes something is off, the professionals have been watching it for a year. Another quiet shift happening in 2025 is sector differentiation. For a long time, credit markets treated many industries similarly because borrowing was cheap for everyone. But now investors are separating companies with real cash flow from companies with projected cash flow. Those distinctions matter more when debt is expensive. They decide who gets funded easily and who faces resistance. Companies with strong balance sheets will come out of this fine. They may even benefit as weaker competitors struggle. But companies whose business models depend on constant refinancing or aggressive expansion will feel the new environment ruthlessly. The market isn't punishing them, it's just recalibrating reality, and this is the part that makes experienced investors uneasy. Not because they expect a sudden crisis, but because they understand how slow credit tightening works. It chips away at the edges: first mid-tier companies, stretched consumers, speculative borrowers, and then gradually moves inward as lenders become more defensive. A credit crisis isn't one moment. It's a sequence. And in 2025, that sequence has begun its early steps. The people talking about it aren't doomers. They're realists. They look at credit conditions the way pilots look at instruments. If one gauge shifts, fine. If several shift together, you don't wait for the engine to fail. You adjust before anything breaks. That's what professionals are doing now. Adjusting, watching, preparing, not for a meltdown, but for a cycle where the cost of leverage, the availability of capital, and the stability of refinancing can no longer be taken for granted. This is the mindset behind the rising talk of a credit crisis in 2025. Not fear, not prediction. Just recognition that the environment has changed and the system is starting to react.